following the largest, technically non-delivery month, just a futures month that really wasn't designed to be a delivery month. The August gold loadout, it was the largest in history, and we expected that any remaining undelivered paper warrants would be forced into delivery by first notice on the 28th of August, which was the last day to contractually deliver or fold your position. And as we've often remarked, in physically settled markets, gold being called for delivery is settled at worst T+1, and in many of the futures markets, the physical markets, T+0, but T+1, meaning 1 day to physically deliver a fully paid up bullion bar. So that should be the worst case scenario, because that is Basel III compliance. Really, we're looking back, I can't believe it actually ending the third quarter. It's been a lot of fun though, pulling apart over the time. You remember we've had multiple official attempts to try and talk gold down, tamp it down. And most recently, this is so recently, Citi, even less than 2 months ago, I think it was 7 weeks ago, whatever it was, tried to gaslight the idea to sell gold because it was going to go down hundreds of dollars to as low as 2,600. Do you remember we kind of laughed at the whole concept of it because we knew they were on the other side. And yeah, this is the same bank that, along with JP Morgan, that we captured and published at that exact same time, simultaneously stealthily closing the Fed's 5-year OCC derivative bets. Remember those OCC bets, the officer controller bets? They're only published quarterly. So these guys get to have a bit of fun and do what they want to do in the dark until it's published. But we clocked it. And this really actually all boils down to the fact that the only central bank still short gold is readying to revalue US Treasury gold reserves. I know there's a lot of skepticism about it. It's happening. And as we've been drawing attention to, and we will look at it again shortly, the clues are all there. And our assessment that the LBMA Comex is no longer fit for purpose is now gathering mainstream attention.
The Federal Reserve now stands as the last major central bank openly shorting gold, using Comex as its primary tool to cap prices. But with dwindling open interest, Comex has lost much of its effectiveness. Fewer participants and declining liquidity mean fewer chips on the table to manipulate. Meanwhile, the mismatch between Western paper contracts and Asia's physical gold demand has grown more severe. The 2018-2019 tariff conflicts exposed just how ill-equipped London and New York are in refining and delivering the kilobars Asia demands. Gold's structural shift is forcing the Fed into an increasingly untenable corner.
And with that in mind, let's look at the current August CME LBMA footprints, which, after the Trump tariff tantrum, further reveal how an dwindling COMEX open interest, i.e. the chips, no one wants to really trade the chips anymore. It's forcing discipline on the Fed, the only remaining central bank trying to cap the price of gold and versus the dollar. And they need the COMEX to do that. And it is just, there's not enough actors. And even setting aside the Western paper-derived price mismatches versus the Asian-facing physical pricing, it was the Trump tariff tantrum that really exposed the massive structural mismatch between the Western gold market infrastructure and particularly the inefficiency of re-refining London 400-ounce bars into 1 kilo bars that Asia demands. Liquidity providers affirm that the remaining COMEX open interest, that's the chips in the casino basically, are insufficient to command enough position concentration to actually meaningfully enable the COMEX-centric paper gold price management to continue. Now, the Fed's price suppression attempts have become so obvious that anticipated intraday, intra-month, COMEX-centric official bid-pulling attempts are capitalized on by the competing global central bank, sovereign, and institutional buyers. Now, these arbitrable physical offtakes are making it increasingly difficult for the Fed to short cover leased bullion borrowings without digging a deeper hole. Into the end of the month, the Bank of International Settlements squaring, the OCC bets, were once again forced to be squared at an all-time higher priced stairstep. And with physical market liquidity now setting the global gold price, the Fed will have to fold its short derivative hand and as quickly as possible get on board the upcoming gold revaluation process. Feedback from every single physical liquidity provider's telegraph that the Fed is anticipated to follow the BIS to also become Basel III NSFR compliant. And remember,
global liquidity providers now favor Basel III compliant trades, where gold must be fully backed by physical metal. This shift highlights how central banks and institutions are abandoning paper hedges in favor of allocated bullion. The Bank for International Settlements already adapted, squaring short positions at higher prices and setting a precedent. The Fed, still clinging to derivative suppression, faces the same decision: follow Basel III or risk irrelevance. With delivery dates looming, particularly the December Comex contract, gold pricing will increasingly reflect real supply and demand. The future belongs to markets requiring tangible metal, not paper promises.
Where the BIS short covered and what happened, and now the Fed is at the position where it's got to short cover. And it's going to have to follow what the BIS did. And then figuring that most likely that the December contract, this is spot here, but this contract, which just launched, which was the December contract, and this reflects that Comex liquidity, is very likely going to have to it'll move into first notice on the 27th of November, and delivery commences on the 28th of November. So this contract doesn't expire until November. So that'll be right around this point here. Well, we suspect that the price is going to be much more reflective of our spot 4,500 target. Cutting through the last 3 weeks of the thinnest European, this was the European holiday here, that liquidity was extremely thin. This tariff tantrum right here was the point that actually exposed the need to quickly address the LBMA CME cartel's paper to physical disconnect. And liquidity providers report the largest exit of LBMA CME hedging flows, ditching these high counterparty risk unallocated contracts for fully allocated physical gold. And that's what we're seeing. Now, the drain of leveraged unallocated LBMA gold into fully paid up physical gold vaults outside the cartel's ring fence will ultimately force the Fed-run cartel to embrace full Basel III compliance or become irrelevant as a gold trading hub. And what we mean by Basel III compliance, they will have to have the physical that backs up these positions. Drilling down, the footprints are revealed one by one. And as we assessed in our last episode,
the August delivery cycle exposed just how fragile Comex has become. Historically, futures contracts rarely required delivery. They were paper shuffles rolled forward at lower costs. This time, buyers demanded bars, not paper, forcing 2.26 tons into physical settlement. Some deliveries dragged to the very last legal day, exposing weak reserves. Such delays reveal the truth. Comex often lacks sufficient real gold to back its contracts. In Basel III compliant markets, delivery occurs within a day, T+1 at worst. By contrast, Comex stretched obligations to 30 days, confirming that its system was designed for price control, not genuine settlement.
Following the largest, technically non-delivery month, just a futures month that really wasn't designed to be a delivery month, the August gold loadout, it was the largest in history, and we expected that any remaining undelivered paper warrants would be forced into delivery by first notice on the 28th of August, which was the last day to contractually deliver or fold your position. And as we've often remarked, in physically settled markets, gold being called for delivery is settled at worst T+1, and in many of the futures markets, the physical markets, T+0, but T+1, meaning 1 day to physically deliver a fully paid up bullion bar. So that should be the worst case scenario, because that is Basel III compliance. Now, a quick delivery enables the seller of those bars to exit their storage costs, hedging costs, insurance costs, all that kind of stuff. So when they drag delivery out into a T+30 day delivery protocol, clearly it telegraphs the Comex gold was never real in the first place. It was just a paper shuffle of warrants. And by delaying delivery, the object was to try and square these paper warrants at a cheaper price. So with that in mind, let's start looking at this last 727 foot dragged. I'll call them foot dragged. These were last second deliveries. That's 2.26 tons of August deliveries were finally forced to be squared last Thursday, the 28th, which was the last contractual delivery day before being called into a force majeure default. Now, these sort of delivery days had historically been able to rig lower prices so they could be cash settle these price suppression bets. However, following last month's record delivery, which the paper settling of these last Fed-centric August warrants clearly didn't go to plan for them. So again, looking at the spot contract here,
the August expiries forced the Fed and its cartel allies to settle positions at increasingly higher premiums. Arbitrage opportunities allowed sovereigns and institutions to scoop up gold while Comex shorts scrambled. With open interest collapsing and insufficient registered ounces to cover contracts, the illusion of paper control weakened further. Meanwhile, geopolitical risks, from trade wars to currency shifts, added fuel. Even Citi, once predicting sharp declines, admitted that algorithmic funds would need to close price gaps. By early September, gold pushed higher, reflecting stronger physical demand and eroding the effectiveness of Western suppression mechanisms. The system is clearly buckling.
Into the end of last month, this is where, we mentioned it a minute ago, this is where they were forced to square the BIS OCC bets, and again, at an all-time higher price stairstep. And this is we froze and captured the action long before the rally really blew up. But essentially, we were looking at the expiring contract. And while about 300 lots of the August open interest was settled at a $5.50 premium to spot, at the 33.9785 AM fix, the remaining 320 lots had to be benchmarked at the higher 34.0765 PM fix. It was commanding a very large $13.20 surcharge. But by the pit close, as evidenced right here, the basis trade had expanded to an extraordinary $27.80, really exposing the so-called Comex quote-unquote hedges as being called for physically delivery were grossly mispriced. And while we saw that then drop down to about $13, still a premium over spot. But this was extraordinary. And again, before the actual breakout, look at where the gold speculators were. And this lack of sufficient CTA open interest to control the price was evident even before the breakout rally. And later data, as of we're recording this on the 3rd, so this is yesterday's data. And so what's particularly interesting is here, you can see that the open interest is really very, very much contained at that price, or even after the rally, that is.
China's yuan-backed exchanges now offer fully physical, Basel III compliant gold trading with instant settlement and no paper dilution. This stands in stark contrast to Comex's leverage-heavy model. As more central banks diversify away from dollar-based gold pricing, the cracks widen in the $2 quadrillion derivative system. Physical demand is steadily draining unallocated LBMA and Comex positions, shifting bullion into allocated vaults beyond cartel control. The evidence is mounting. A gold revaluation process is already underway, driven not by Western forecasts, but by global sovereign demand. The age of paper dominance is fading. Physical gold is once again setting the price.
And this clearly evidencing the shortfall of eligible, registered, and ounces, total contract ounces available. And while it's helpful to shed some immediate speculative froth, which always jumps on or coattails a physically move higher, given the strong physical market is securing higher dip buying stair steps, which we've been tracking for many months, and note this was the breakout point, there's plenty of upside room for specs to add longs. And we're recording this after London's cleared, and it's still, gold just happens to still be making fresh highs. This is spot. Also, just ahead of the breakout, the once bearish Citi also estimated that CTAs will have to close the EFP gap into September. Post that breakout, it's clear they weren't pushing this narrative very well, clearly. Also, slumbering volatility into heightening geopolitical and trade war escalations telegraphed that gold was coiling for a strong upleg, followed by the breakout. Shane, to get some more subscriber questions and update what we did assess into our last episode, it's clear that the tariff flip-flop ejected a critical mass of asymmetrically imbalanced Comex hedging flows. In other words, open interest, the chips that float around, they weren't one-to-one, and they got caught out. And they got caught out into Basel III compliant physical exchanges, taking this, demanding this bullion. Also, with the US dollar redeemability into gold completely usurped by China's yuan, one-to-one Basel III global convertibility into gold, and the COMEX diluted prices being targeted through its EFP backdoor Achilles heel, accompanying dollar-based paper gold suppression tool, it finally blew up. We looked at it last time, coming dangerously close to blowing up the interconnected $2 quadrillion derivative markets. Now, the SGEI, the international facing, Western facing T+0 vaulting hubs, are sufficiently liquid to accommodate as much one-to-one physical gold hedging business as is needed, uncovering a series of central bank sovereign and institutional sized gold revaluation footprints. Now, there's other bullish drivers that we've been monitoring, and they're also gaining stronger legs following this tariff tantrum.